For more on the global market sell-off, we're now joined by Ashraf Laidi. He's Chief Executive Officer of Intermarket Strategy. Ashraf, good to have you with us. I've been reading you on Twitter this morning. You've had plenty to say about the lowering of the peg on the Chinese yuan by the People's Bank of China. How far is this going to go? This, I understand, is the 8th consecutive day that the central bank has effectively devalued the yuan.
Yes, Paul. Hi, good morning. I mean, what the Chinese are doing, they're telling the West, look, you have been pressuring us to make our currency more of a free currency, and the data gets poorer and poorer, and the currency weakens. So what they do every day, 1:15 a.m. GMT, they announce a fixing for the yuan against the US dollar, and out of which, or away of which, the onshore rate is not allowed to go up or down more than 2%. So what they do, they feel that there is downward pressure, and the question is, why do they issue the fixing much lower than last time? Because they think and they know that there is a pressure coming in on the offshore market, the market that the PBOC supposedly does not intervene in. So the data worsens, and this is all before the Korea story came in. And what traders are looking at is that the world's biggest buyer for commodities is letting its currency weaken, because it should, and when that happens, the markets go down. Asian equity markets go down. The futures market in the U.S. go down. The yen is the safe haven, and it rallies against everything, including the U.S. dollar. And then the U.S. dollar starts to fall across the board, even against the euro, because when the tightening of the markets happens in this way, it does reduce chances that the Fed will raise rates.
Ashraf, Paul Taylor here. You talked about currency intervention. Obviously, markets around the world are reacting to the market turmoil in China. The question is, what about, what's the direct linkage with the pace of Chinese economic growth? Yes, there's concern that we have seen some weakness, that may persist a bit, but is what's happening in the equity market in China necessarily linked to significant weakness in the Chinese economy, or are markets getting ahead of themselves at this particular point in time?
Yes, it is very difficult to have a market in any nation be immediately close or reflecting the economic case there. The manufacturing is slowing, but we know that the services sector in China is okay. The consumers are still doing well, and they still spending money. We still have to know the reason why Apple's saying they're going to reduce output. Is it to do with the Chinese market? But Paul, yeah, I mean, maybe you can see the deterioration in the market is basically playing catch down with the artificial intervention that happened in the last 3 months. So the markets come down. The question to ask, will the market be feeding in a negative way into the macro story? Let's not forget, the manufacturing situation is bigger in China than in the US or in the UK. In the US, the Federal Reserve, the central bank of the United States, has been basically successfully ignoring the manufacturing recession, raising rates or normalizing rates, while the services sector is doing well. China still does not allow to do that, because it still have a huge excess the capacity there. So the question is, will the macro story worsen when the excess stays the way it is and the markets speed lower?
George Soros getting some attention today for a comment he's made, I understand, in Sri Lanka. He says, when I look at the financial markets today, there's a serious challenge, which reminds me of the crisis we had in 2008. Is he justified in making that type of comparison?
Maybe not. Maybe maybe not a justified, there's no subprime crisis and so on and so forth. But here is the thing, Paul, when these things happen, when Greece happened, the market have a way to shrug what is going on in the United States. And now it is China. Yesterday, the day before yesterday, was Iran and Saudi Arabia. And then it was Korea. Oil is still falling. We still expect oil is going to fall below 30 and it's going to go towards 25. Need we answer? And what's going to happen for the shale oil guys in the U.S. and the high yield, the spreads? Maybe they say, oh, but it's just an energy story. Well, 7 years ago, they said it was only subprime story. And then there's something else, the Saudi Arabian rial. They have oil. They just raised the petrol prices for consumers by 40%. Austerity is written large and long there. If, and I say if, and I think there is a 30% chance, if the Saudi rial peg breaks away from the dollar, yes, you can say they have a lot of FX reserves and so on and so forth, but they're using them for a war, for many other things. If this happens, we may see oil just like that going to a 25 or maybe to the 20 level, and maybe we can have another case of the SMB, a reverse case of the Swiss National Bank. And if oil prices come down, it will be a very good reason for more than now, for stock markets to fall harder than now. And we could be, and actually we are looking for a U.S. recession in the third quarter, and for bond yields to go towards 1.5, that is a 10-year in the U.S., and not 2.5.
We'll leave it there. Lots more to talk about, but we are out of time, Ashraf. We're grateful for you making time for us. That's Ashraf Laidi, Chief Executive Officer of Intermarket Strategy. He joined us from London.